Welcome to the third quarter of 2022 commentary. My name is Lorenzo Pederzani.
And I'm Matthew Evans.
And we are the two portfolio managers at Westmount Wealth. The third quarter was really no different than the rest of the year, seeing a tremendous amount of volatility both in stock and bond markets. We're here to provide a little bit of perspective today on what happened. As always, we like to encapsulate each presentation with a bit of a quote. Our quote today comes from Charlie Munger, Warren Buffett's longtime business partner, who said, "The big money is not in the buying and the selling, but in the waiting." And I think that's particularly apt to get us in the right mindset to deal with the volatility that we're seeing right now in the markets. So let's get into it. I'm going to pass it over to Matt Evans to talk a little bit about what happened this quarter in the markets.
Well, as Lorenzo mentioned, there was a tremendous amount of volatility seen in both stock and bond markets. And it's no surprise that the four themes that led to the volatility this year are the same themes that are providing the same kind of volatility this quarter. So we've got high and persistent inflation. As you can see with the chart below, with the dark blue line, we've got headline inflation up in the 8% range. And we've got core inflation, which removes some of the volatile categories like energy and food from the mix, sitting at about 6.3. The challenge is we historically like to have inflation around the 2% mark. So up at 6 or up at 8 creates a lot of volatility in the markets as the central banks around the world try to bring down that inflation to that 2% historic range. Also leading to this inflation is the conflict that continues with Russia and Ukraine, entering into its 8th month. So to combat this high inflation, central banks, and in this graph below, we're looking at the Federal Reserve, started a path to increasing rates. So you can see coming off the bottom during COVID, we've increased rates since March of this year. And that has led primarily to the volatility we've seen in both stock and bond markets. As you can see with the dotted line after the solid line, that shows the path of where rates are expected to go. So as you can see, no surprise, rates will be moving higher. And all of that will lead to recession odds increasing. So you can see some of the indicators put out by RBC are starting to flicker red or amber, showing that the economy may be entering a slowing phase. So with all of that, Lorenzo, why don't you explain how each asset class has performed?
So it is not unusual as investors to see equity markets down 15, maybe even 25%. It's something that as investors we can normally expect 2, maybe even 3 times in a decade. But what is highly unusual is to see bond markets down more than 2 to 3%. How bad did it get this year? Well, if we take a look as of September 30th of this year at the Canadian bond index, you'll see it's down almost 12% year to date. The US Ag Bond Index, which is the most widely tracked index for bonds, is down almost 15% year to date, and global bonds are down almost 17% year to date. Just to provide a little bit of context around that, if we look back at the last 46 years and ask, how bad has it been in US bond index for any calendar year, we can see that in those 46 years, only 4 of those 46 years have had negative returns, and the worst of those returns was down only 3%. This year, we're almost down 15% year to date. So the asset class that's supposed to be protecting investors when equity markets are unstable is failing just at the time when investors need it most. And now looking at the stock market returns, you can see that Canada's had one of the best performing equity markets in the world, largely due to the commodity exposure that we have, with equity markets in in Canada only down 11% year to date as of the end of September. US markets, whether you're looking at the S&P 500 or the NASDAQ, down about 17 to 26%, and international equities, so developed world outside of North America, down about 20%. So we're definitely seeing a recession priced into the equity markets around the world. And certainly, we can see that historically, about 3 out of 4 years tend to be good year in the markets, and about 1 out of every 4 years tend to be bad years. And we're seeing one of those years right now, and a particularly difficult one at that. So when you take a look at the fact that both equity markets have been very volatile and bond markets at the same time, the traditional balanced investor, or somebody who would be described as holding 60% exposure to equities or stocks and 40% exposure to fixed income or bonds, that person's diversification mix has really failed them this year. In fact, if you take a look at the center of the bar graph that we're showing here, the majority of the time on this bell curve, probably about 50 to 60% of the time, investors in a balanced portfolio over the last 100 years are experiencing somewhere from about -5% to about positive 15% on a calendar year basis. This is data from 1928 up until year to date as of September 2022. What we're seeing right now at its worst point in 2022 was a return for an investor which would have held S&P 500 index and 10-year US Treasuries as their 60-40 asset mix, a portfolio that touched a low point of down negative 18.5%. So essentially the third worst return for a balanced investor over a 90+ year period of time. So it's been a very difficult year for investors, and consequently, many people are wondering, have we touched the bottom? So Matt, can you provide us a little bit of context on that?
I think I'll start off by explaining what happened during COVID, because it was an interesting time where we were all locked up at home, and a lot of clients were saying, Matt, why is the equity market or the stock market going up? Well, the economy seems to be contracting. So what we're going to explain here with this table below is the stock market is not the economy. In the economy, we're going to use GDP as the indicator. So on the far left column here, we've got 6 instances of a stock market bottom. To the right of that, you will see the bottom of the economy, or when the economy bottoms out. As you can see over the 6 instances listed, on average, the stock market will bottom out about 4 months prior to a recession or the GDP bottoming out. And by the time the GDP bottoms out, on average, about 4.5 months later, the stock market has returned pretty healthy returns. So we always say to clients, we don't know when the bottom is going to be. That's always in hindsight, but we do need to be long-term equity investors if we want the growth from the stock market. And as you can see with the 4 graphs below, we're showing the 1-month return off of a bottom. And you can see it's pretty strong. So when you get all of the negative sentiment that we have, all of the negative news priced in, when the market does turn, it can turn quite quickly and quite violently. So we're gonna go over just a slight portfolio update first, but I thought it would be a good idea to take a step back and go over our investment philosophy. So there is a 3-part investment philosophy that we follow. The first is low-cost, broad market stock exposure. The second is we utilize a tactical overlay on that broad market exposure that will move with the general macroeconomic factors. So we may tilt to the United States, we may tilt to Canada, for example. And then we complement that with a healthy dose of alternative or private assets that help increase the diversification of the portfolios for the clients and hopefully create a better investment experience. So let's take a look at the first point. Broad market, low cost exposure. Why do we do that? Well, as equity investors, we have 2 choices to make. We can either just buy the index through an ETF, a low cost ETF, or we can hire someone to make decisions on our stock portfolio and buy and sell securities in an attempt to outperform. So there's a cost when you hire someone, and that cost is captured in what is called a management expense ratio, or an MER. So what we're showing with the table below is, let's take a look at the percentage of managers, active managers that have that additional cost. What percentage of them can beat that broad market or low cost index? As you can see in Canada, over 3 years, it's about 11 out of 100. However, if you hold that longer, 5 years, it shrinks to only about 6. If you look at US markets or global markets, it's even worse. With 5 years, only 13 out of 100 managers beating the low-cost index. So looking at this data, you can see it is very difficult to be persistent and outperform the markets because of that higher cost. And that's why, as investors, we say, let's just tilt the probabilities in our client's favor. Let's just buy the low-cost index and pair that up with some tactical positioning, as I explained before. So as an example of some of the tactical positioning we have in our models right now, we've got an investment in the renewable energy transition, which we are gaining exposure through our Westmount Real Asset Fund and the AGF Global Sustainable Growth Fund. In addition to that, we've used some tactical positioning to add to the market, or the side of the market that's pulled back the most. That is the high-tech growth area of the market, mostly found in the NASDAQ. And we've hired a firm out of the United States, T. Rowe Price, which is distributed through TD, and that's the TD US Blue Chip Equity Fund. We combine that, like I said, with private assets. These assets are not marked or priced daily in the market. Instead, this is direct ownership of, in this example, real estate that gets appraised. As an investor, you get the appraised value monthly of the real estate and you collect the lease payment. So here we're going to highlight the Manulife Canadian Real Estate Fund that has done quite well for our real asset fund. And that return was primarily driven by the industrial warehouse exposure that it holds. So it's just a nice way to diversify client portfolios, provide them with that industrial real estate exposure that you can't capture that much in the public markets, as well as providing that lag valuation, which helps improve that investment experience for the client. So with that, I'm going to pass it over to Lorenzo to go over the last part of our presentation today.
Warren Buffett once said, the stock market is designed to transfer money from the active to the patient. And again, I think that sentiment is very true in what we're seeing this year. On this next slide, you see a headline that says, stay calm. And this is a slide that I've actually been using with clients for almost 20 years now, and I keep updating. And I think it's very interesting because what we're looking at here is over 70 years worth of history. And in the center there, you see all of these major world events that have happened over the last 70, 80 years. And it is very easy for us as humans to be fearful and to feel that now is not a good time to invest. The problem is we know two things. One, it's impossible to time the markets because you've got to get the call right 2 times, not just when to get out, but also when to get in. But secondly, we know that historically, markets tend to go up over time in developed countries. And what we've seen on this graph, we're showing the decade returns for both the S&P 500 and the TSX. And with one exception, being the dot-com bubble in the S&P 500 during the 2000s, in every decade, we've seen the indexes up over time. We don't know what the returns are going to be for the 2020s, but we know that decade to date, both the S&P 500 and the TSX are still in positive territory despite the big pullbacks that we've seen this year. And we'll leave you with one example of that, which is the idea, coming back to this idea of market timing, because as I mentioned, the idea of market timing is extremely difficult and I would suggest impossible because effectively you've got to have a crystal ball knowing when to get out and when to get back in. And this is a very interesting hypothetical example that we came across recently of an investor who starts investing in 1990 and they invest $1,000 a year. One investor has perfect timing, which is shown by the blue line, and invests at the lowest point of the stock market in that calendar year for that whole period of time. Then we have somebody who's unlucky, which is the red line, and who invests at the highest point of the stock market for that calendar year. And then in the middle, we have somebody who just doesn't think about it and saves 1/12 of $1,000 or $83 a month every month for that period of time. And as you can see, the dispersion of outcome is actually not that great. The person that had perfect timing is not actually that much better than the person who had the savings discipline of saving on a monthly basis. But the biggest mistake any of those people could have made is trying to get out of the market and figure it out when to get back in. So the bottom line is that time is your best friend when it comes to investing. If you take a look here at the table that we're showing, the gray line shows the returns for a balanced portfolio over a 1-year period of time, historically, over a 5-year, a 10-year, and a 20-year. And the two numbers you see in that gray bar show the best return over a 1-year period and the worst return. As you can see, by the time you get to a 5-year period of time for a balanced investor, there is no period of time that we would have seen historically where you're experiencing a rolling negative return, as a well-diversified investor. So yes, it can feel very comfortable to an investor from time to time, and that's a normal part of the investing experience. On average, market cycles have lasted, at least in the US, about 5 years. 4 years up, 1 year down, if you want to really simplify things. But over time, time takes away the risk more than any other factor. The bottom line is that we don't know when the markets are going to hit their bottoms, but I would suggest that as investors looking at the data, we feel that we're probably reasonably close at this point. That's not to say that the volatility is over. I think we're going to continue to see volatility in the markets until we get a sense that both, at least in North America, both central banks have stopped their interest rate hikes, and probably until we get some more clarity on what's happening in the Ukraine conflict. That being said, certainly the recessions have been priced in the equity markets, and bond markets, as we've seen, have experienced their worst year in probably at this point over 80 years. So, it probably only looks up from here, but how long that takes is anybody's guess. The most important thing is to try and calm our fears and to focus on what we can control. That's it for our third quarter commentary. Always happy to answer any questions or comments you might have. We'll see you next quarter.
Thank you for joining us.